Hello everybody. So I want to share a simple strategy with you called the open range breakout strategy. So there's a lot of people that trade it with some great success and some people that trade it with some mixed success. So what I've done is to formulate a set of rules as to how I trade an open range breakout. And it's not something that I trade often, but I do use it as a method to see whether my selected direction is correct. So basically what it is you are using the first hour of trade as your range. Now, it works on pretty much any market. I find with forex, you use the first 4 hour. So the last 4 hour candle before the market actually opens at 9 o'clock in Europe, you use that. And with the indexes, I use the first hour. So for Europe, it'll be currently from 9 to 10, and for the US, it'll be 3:30 to 4:30. So I'm going to show you on the Dow how I do this, because last night there were some very interesting things that happening on the Dow, which I know some people got caught on the wrong side of the range break, and I want to give you some tips as to how I prevent myself from getting caught on the wrong side. Okay. So firstly, what you need to do is, for the Dow, we've got to go to the 30-minute, because it opens in a half-hour period. And let me just get my range tool. So we're looking for Tuesday at 3:30 and 4:30. So it's basically from there to there. So this candle here is our 3:30 candle, and the next half-hour candle is this one, which is our 4 o'clock candle, which closes at 4:30. Okay, so there is my hour. Those two red candles is my hour. Now, the challenge with a range break strategy is you can automate them, okay, or alternatively you want to sit and watch. Now, the concept is quite simple, is when you break the top of the range, you are long and your stop loss is below the range. When you break to the downside, you are short and your stop loss is above. But if you have a look here, you can see how this is a tail and these are tails. So if you're going to trade this thing, for example, on the 5-minute chart, you'll see you had a breakout here, and immediately people will be saying, all right, this is a long, okay? And then you've got breakouts to the downside where they would have got stopped out. So in order to prevent this, because this was, in my mind, a fake out, there are a couple of things that I pay attention to. So before I get to that, I mean, those of you that follow me, my videos, you'll know that I pay attention to things that are happening on the weekly. So first things first, I don't want that line, I want that one. First things first is I have weekly Kijinson over there, okay? I then have the daily cloud sitting here. Okay, so I have one level, I have another level. I then have multiple breakout levels here. So I've got there, and then I have one there. So top of that pin bar there. So those are my levels. And we can go to the 4 hour, and we can add some more if you want to. There's a flat cloud there. Okay, and there's another flat cloud there. Basically, you can see how messy this is becoming, but my point is that there's a lot of resistance in this area. So trading to the upside is probably not something that I'd want to do right now, normally anyway. So that's the first thing, is to take cognizance of what's going on around you. And you can see you've got all these areas here. Let's get rid of that one. Let's get rid of that. Rid of that. get rid of that. Okay, so what I do if I'm going to trade a range break is I go to the 10-minute chart, and I will need a 10-minute close above the range to indicate that we're going to the upside. But bear in mind, my bias is already to the downside because of all this resistance that's just above it. Okay, and this confirms my suspicions on the 10-minute. You can see I'm getting breakthroughs, but I'm not getting closes. And I need a close above this range in order for me to convince that we're going to try and break through this level here. Instead, what do we get? We got a breakthrough to the downside. Okay, and then we just form the bigger range, which is typical of this kind of scenario. So what will happen is typically we need to now watch this because we're now sitting at the 50% of yesterday's range, and it could still get a 10-minute close up and go up and hit its targets to the top side, or it could do it to the downside. I mean, jury's still open on this one right now. But ultimately, the minute you saw that at levels, it's the opportunity to say, well, this is actually the top of the range. Let's play short for the bottom of the range. If you get a break here, you can still leave your stop. You can basically move your stop right over here. I think let's get a nice one here. Get rid of that. So now, when you're far away from support and resistance, it works a absolute charm. That's Tuesday. Let's look for here. Okay, so we're on the 10-minute now, so 15:30. So there's the bottom. Okay, and we're looking for 16:20. There it is there. So you can see how we didn't get a 10-minute close, but then we get a massive 10-minute close here. Okay, outside of the bar, which gives you the indication. But again, at this stage, we're trending up. And if I come to, where is this? 24,600. So let's go to the daily. And we have, well, first we've got this level here. And then we have that level, this level, this level. So we've got quite a bit happening here. And you can see this level here is where we bounced off, and then we had this lovely close through it. So probability is this is a breakout. Where is it going to? It's going first to the height of the range, which is there. Okay. Then it comes back and it tests the breakout, which is here. And the breakout lines up with a big resistance area, which is now becoming support. And then we continue and have a look where the next target is, which is the 161% extension of this range. So, and this happens the following day, the following morning. And on the Dow and the DAX, S&P, or even Aussie, pretty much most of the indexes, the previous day's range influences the next day and the next day. So your targets, you can see how my target, there's my target, profit taking, there's my next target area, which is the 160. So this is the range height, this is the 161% extension of this range, and this is the 261% extension of this range. So often a range break in a trend like this will hit all the targets going up. And yeah, so more often than not, you can go back and back test it. I mean, I've spent many hours going through these ranges and seeing how they work, and I can actually talk quite a bit on how ranges in the past actually influence ranges in the future. But that just starts making things too complex, and I'm not a believer of making things complex. Try to simplify them. So Open range is the first hour of trading. Look for a 10-minute close outside the range. You can either take the trade there, or you can wait for a retest of the range and get in there. And then your targets are, the first one is the height of the range. So from the open to the close of the range. So if you look at this, so we have basically 92 points, and 92 points is your target. Okay, so it's 92 points from the break, not from where you get in. Just bear that in mind. And if you want to save yourself some sanity and you're playing this, then you take profit at this level, wait for the next pullback, and then it'll go. Okay, you'll see that I have another line here, the 138.2, so it's a 38.2% extension of this range. Often, when we get to this point, price bounces back to test the range or comes back to the 50% of the range before doing its proper breakout. So I basically use that just as a yardstick. And stop loss is always below the range. Okay, if you're going long, stop loss is below the range. If you can't afford that stop loss, don't take the trade. Simple as that. Okay. If you can afford that stop loss and it's within your 3% risk profile, then by all means take the trade. Your probability of success is a lot higher than failure, unless you are trying to do a range break in a major area of support or resistance. So, especially when you're manually trading this, the first thing you should be doing is draw your support and resistance in on the higher time frames. Get them in so you know what you're dealing with, and then you can continue. And you can see in times like this on the Dow, where it just trends to the upside, obviously the only thing you're looking for is longs. So your range breaks will always be to the upside. Any range break to the downside is not something that you're going to pay attention to, because often those range breaks to the downside are short and sweet. And I think then the last thing to point out on ranges is your first hour and a half of the day is essentially going to give you the direction. So once the first hour and a half, so this is the first hour. Where are we? Okay, so up till this candle's the first hour. Then 1, 2, 3. Let's just put a block around this. There. All right. Okay, it's not this one, it's from this bar here. So that's half past 3, 2, half past 4. That's 4, 10, that's still there. Okay, rectangle. To the end of that bar, okay. Okay, so from this bar to this bar, that is our first hour and a half. No, to this bar. So our first hour and a half trading is from there to there, and that typically gives you the direction. So the minute I create a new high here, the highest probability, and it's basically 90% probability that your high, so your low of the day is in this case, because what it is the first hour and a half, if I create a new high, and there's my current high, there I create a new high. As soon as that happens, then this low here is more than likely the low of the day. And you can see, that you can test as well, and I encourage you to do that, to actually work through the historical data and see that. So it's just basically how price action works. All it's saying is that if we're heading up for a solid hour and a half, then basically what the institutions are trying to do is drive the market up. If we're heading down for an hour and a half, for the first hour and a half, then the institutions are trying to drive the price down. And so that's typically what will happen for the day. So your low of the day will be in as soon as you break that. So you can, with confidence, you can leave your stop here and let that happen. And I'll use an example here. For me, the minute we broke to the downside here, I have confidence that the high of the day was in, and I can move my stop down, although I haven't, because there's a lot of support and resistance here. So that's kind of how you play the ranges. It's actually a very great way of playing the market if you're new to the market as well, because it's a very finite set of rules that you can follow. And just to summarize, support and resistance on your dailies, your weeklies, your 4 hours, extremely, extremely important. Okay, so draw those in. If you have a range that's opening range that's forming in that zone, then proceed with caution if it's going to indicate continuation, because often the breakouts fail. And you could be sitting with a situation like this where you are either stopped out unnecessarily, or you're in panic mode because you're not sure what's going to go on. And if you understand what the price is doing, and it often does this, often does what it's doing now, it's just ranging on this. Okay. And then these levels, pay attention to them because they work. I'm not going to say anything else about it. They work. I've spent many hours calculating exactly where price goes to. And it's a question that I continue to ask myself: where is price going to? And you can draw these ranges on the open, and you can also draw them on the close, the last hour of close. And you'll see exactly the same picture forming. Anyway, guys, I hope that helps you understand how I trade open range. And as I say, not that I trade it often, but it is a nice trick to have in your bag of tricks, because it allows you to build confidence as well, because you often, like, just following the rules, you'll get it correct most of the time. Well, guys, hope it helps. Catch you later.